Hello, everyone, and welcome to Schwab Coaching. My name is Cameron May. I'm a Senior Manager of Trading and Derivatives Education here at Schwab, and this is Trading Covered Calls and Short Puts. And this webcast series is all about using options to pursue income. So we're going to be looking through that lens at both the start and the end of a potential income strategy. We're going to be walking through 5 current example trades. We're going to be adding a new trade, all oriented toward income, all really focusing on when might a trader enter into an income strategy? When might they choose to exit? Should be a lot to cover. Before we get to any of that, though, let me first of all say hello to everybody who's chatting in from all around the country. Great to see so many of you out there in YouTube. Hello there, Mark and David, Greg, Ricebird, John, Lawrence, Kevin, Eva, Bob, on and on the list goes. Thanks for everybody for joining us today. If you're here for the very first time, I want to welcome you as well. And if you're watching on the YouTube archive after the live stream is concluded, well, enjoy the recording. That's a fantastic way to watch these webcasts. But if you'd like to join us here in the live stream, you're certainly welcome. This is a Monday webcast series. We kick things off promptly at 2 Eastern Standard or Eastern Time. We'd love to have you here in the live stream audience. Now, as a special treat here for my live stream attendees, we have my new friend, Rachel Deshelle. She's joining us in the chats. Rachel's going to be addressing any questions that I can't get to just during the flow of the presentation. She's also the newest member of the coaching team. She's been with us now for a couple or 3 months. What is it now, Rachel? But in any case, fabulously qualified to be here. It's great to have her on the team and appreciate her assistance in picking up the slack for me. She's going to be watching the chat questions. If I can't get to those, Rachel's going to be grabbing the ones that I can't get to, as long as it's not too far off topic. So thanks for having my back there, Rachel. Rachel and I would also like to issue an invitation to everybody listening to follow us on social media. You can follow Rachel on X at Rachel-CS. Now that's DASH, not, like a dash, but the word. You can find me on X at Cameron May CS. Now, you can also find and follow me on LinkedIn. So you just use the traditional LinkedIn prefix, go to linkedin.com/in, and then /Cameron May CS. You'll find my profile. Give me a follow there. But let's get right to it. And of course, as we dive into this discussion of 6 example income strategy trades, these carry risks. So we need to keep this important information in mind. Options carry a high level of risk and are not suitable for all investors. The information here is for general informational purposes only. It should not be considered an individualized recommendation or endorsement of a particular security, chart pattern, or investment strategy. Schwab does not recommend the use of technical analysis as a sole means of investment research. Investing involves risks, including the loss of principal, and any investment decision you make in your self-directed account is solely your responsibility. All right. So let's set an agenda for today's discussion. As I mentioned, this webcast is part of an ongoing series of discussions, all oriented toward using options for pursuing income. So we have 5 example trades that are already in place in our example paper money portfolio. So the first thing that we're going to do is have a look at those 5. And I think that there are at least a couple that need some specific attention, maybe changes to be made to those today. Then when we're done with the current example trades, we'll take a look at the markets, the market conditions for stocks and for options. Then we'll look at adding a new income trade to our example portfolio. So that gives us opportunities to see things from both ends, managing the trades from start to finish. So let's go right to the Thinkorswim desktop trading software platform, look at the current positions. Doing quite well overall. Of course, these are bullish strategies. Markets have been cooperative for bullish traders and trades, really stretching all the way back to April with obvious shorter-term exceptions. For example, we've been pulling down for a few weeks, but rebounding over the last couple of days. But right now let's start with our Broadcom position. Bought 100 shares of Broadcom, sold a 5th of December, 390 call. So what our preference here through the 5th of December it might be, if this trader prefers to hold on to or retain those shares, they might prefer for the stock to go up, helping out the value of those shares, but to stay below 390 to try to minimize the likelihood of assignment on those contracts, or at least in this case on that contract. So actually, that's quite close to what exactly we're getting. The market price of Broadcom is actually way up today. Look at this, up $34 to 373.90. Here's what that looks on the chart. So here's where we bought our shares. We've already sold and had expire a short call, made a profit of $2.83. We sold another short call up here at the 390 level. That's our current position. So our preference here is for price to go up, but to be below 390 as we hit that 5th of December expiration. And that's really just what we've seen, especially, boy, today. This has really been popping higher. We're going to let that one continue to work. This is not the one, or not among those, that I thought might need some attention today. Next up, though, is BAC, Bank of America. We own 200 shares. This is neither a covered call currently, nor is it a short put. Isn't this webcast series called Trading Covered Calls and Short Puts? It is. Yeah, this was a covered call, but those calls that have been closed out. So right now we just own 200 shares of Bank of America. Purchased those for $50.58. They're now worth $52. So those shares are doing just fine. Let's go see what's going on with the history of this trade and with the chart scenario right now. So we bought 200 shares right here. It's been kind of an up and down process since then, but overall, we're still seem to be holding with this upward trend, which has been good for share ownership. We've already realized gains of $1.70, $1.07 per share on some October calls, $1.27 per share on some November calls. So maybe it's time for December. Let's sell some new calls because those November calls just expired. And you can see late in the week last week, we got really close. How high did we get? 52.95. Yeah, we were 5 cents below the $53 strike there, and then pulled back for Friday. So those expired worthless. Let's say that our trader is still bullish on the stock. Let me make a quick observation here. You might note, yeah, we've been really climbing higher, just following an apparent price ramp there. And it looks like we might be bouncing against that again. Let's see what we might be able to get for possibly a $54 call, maybe a 54.5. Go have a look. Let's go to the trade tab. And I'm going to put this contract on for the December 19th expiration. Let's go out to the 19th of December. We were looking at maybe the 54 calls. All right, those are worth about 46 to 50 cents. If we go to 54.5, about 34 to 36 cents. Of course, the higher the price we try to sell, in other words, giving someone the right to buy our shares, but they have to pay us a higher and higher price for that, the smaller the premium that we might receive. So I think what we'll do, let's sell these calls right up here at this most recent resistance. And so for some traders, when selecting a strike price, they might look to previous highs as a potential price ceiling to maybe minimize the likelihood of assignment. Now, we could certainly still be assigned. And particularly if we push through that price ceiling, we go higher. If we are assigned, what that would mean in this case is we wind up selling the shares for $54 that we previously purchased for $50.58, and that would be essentially a forced profit-taking scenario. Okay, let's go do that. Let's go to the trade tab. And remember, we have 200 shares of Bank of America. So we'll go to the 19th of December, go to the $54 strike. Let's click on the bid price and create an order to sell 2 contracts for 200 shares, obligating us to potentially have to sell those 200 shares for $54 each. Let's see if maybe we can get, let's say, 45 cents. I know it doesn't sound like a lot, 45 cents, 46 cents, but on a $52 stock, this is still on the order of about 1% or less than a 1-month contract. Let's click confirm and send. We're going to sell those 2 calls, try to get 45 cents for those. The max profit for the calls would be 90 cents. The max loss, if this were naked calls, would be infinite. It's not naked. This is a covered call discussion. But this would leave us with a net minimum acceptable credit of $88.70 for this trade. Let's send this off. Let's see if we get a fill. Yep, sold for 47 cents. So, all right, so we've made that decision. We've not rolled into, but sold a new call. Let's go to our Alphabet trade. This is another covered call. Own 100 shares, sold the 315 calls. These shares were purchased in January, a long time ago, for 199 bucks. They've really done well since then. We've just recently sold this 315 call. We sold that for 277. It would actually cost us 1387 around there if we were to exit that right now. Tragedy, right? Now that's the case because our shares have done so well. So here's what's going on with Alphabet. Go. We purchased the shares way back here. We sold the contracts. I believe this was last week's trade. Yes. So this was a call that we sold last week. So that would have been on the 17th, right here. I'll put an oval around that. So just to give you a visual reference there. Sold the calls there. We thought we might have some price ceiling right here. Didn't work out that way. We blasted up through that. We've actually even blasted all the way up to our strike level right up there at 315. Does this mean the contracts are going to be immediately assigned? They could be, but probably not. When we go in the money, that does elevate the risk of early assignment. Early assignment can happen at any time, even if we're out of the money. It's just more likely if we go in the money, more likely still if we get closer to expiration. So there's still some time before expiration. But let's assume these got assigned. All right, that means someone buys our shares for 315. We bought those shares ourselves for 199. So that would now be a realized gain of over $115 on the shares. Not exactly a tragic outcome. If a trader really wants to hold on to those shares, though, they shouldn't be selling covered calls in the first place, most likely, because getting assigned, getting called out is always a possibility. But we're going to let these ones work. All right, shares are doing well, might get assigned, might not. Well, spoiler alert, this is a paper money account. We won't get an early assignment. It doesn't happen in paper money, but it certainly can happen in real money. So let's go on to our Microsoft position. Now, this is a short put. Notice how many days, 788 days. This was a discussion we were having about traders who sometimes sell contracts for a very long term. And maybe they are patient to wait through major oscillations on stock price, waiting for an opportunity, hopefully in that time frame. It might be 2 years like this, might be longer, it might not be quite as long. But maybe they're just waiting for an opportunity to try to buy those puts back at a lower price. Maybe the stock makes a nice run upward at some point during that time frame, and they look to buy those puts back. That's not what's been happening with Microsoft since we sold those. So here's the history for Microsoft. We sold these puts. Actually, I don't have an oval on this. Let's do that. When did we sell these? This was 2 weeks ago on the 10th. So we sold those right here. It was this day. Looked like we had a nice support bounce going on, but the price is actually broken down below that support. That's not what we might hope for with a bullish position like a short put, but we sold way down out of the money down here. Our break even is at 357, which I think begs the question, if the stock is way up here and our break even is way down here, why are we not at break even? If we look at our profit or loss since we opened this trade, we're not breaking even, we're losing money right now. Well, the break even numbers that I provide and that we commonly see throughout the platform, those are always assuming that we've reached expiration. We are nowhere near expiration here. So that break even's interesting. It's an interesting landmark for the trade, but it assumes that we've gotten to expiration. We're not there yet. So yeah, this one I think needs to continue to work. We're still way out of the money. Not great out of the gates, but we'll see if this can improve in coming weeks. I'm going to let that one continue to go. But NVIDIA is our other one that I think that we need to do something with today. Another one where the short call has expired. No longer a covered call, it's just a stock position. So here's what's been happening with this stock. And you can see we bought the shares for about 184. It's trading for about 182. So This is reporting that we're losing money on this trade. We're actually not losing money overall since we started our NVIDIA position because of the income that's been collected. So we bought these shares right here. Let me make sure that I have the right 183.71. Is that right? Yeah, that's right. Okay. Anyway, bought the shares right here, sold a call right there, the 14th of November, 195 call that went, it went in the money, went back out of the money, back in the money, fell back out of the money and expired. So that expired for 340 profit. So that's $340 setting, commissions paid aside, $340 realized gain against the paper loss that we have on the shares of 160. And we're still above water, above break even on this trade. I think what we'll do here, we waited to see how an earnings went, and it was quite a choppy earnings. I think a lot of people following that NVIDIA earnings opened really strong, faded heavily into the close of the day, and now we're just starting into maybe recovering. We'll see. Let's say that our trader still wants to hold their shares, and they're still okay with selling calls. Where might they sell a call? I wonder if we could get a premium above or near Friday's highs. Was that Friday? That was Thursday's highs. I wonder. Let's see. Right up there-ish. What is that, 195? Let's go have a look at the 195 strike. That's, that's a good distance out of the money, but for NVIDIA, still about 350, 355. A lot of that volatility in NVIDIA has not necessarily bled out of the stock yet, still getting quite a bit of day-to-day movement. And when there's higher volatility, premiums tend to be higher. So we might be able to get about 2%, even going up to those previous highs and selling there. I think that's what we're going to do here. So with NVIDIA, we just have 100 shares. Let's sell that 195 strike. Let's make sure that we're just doing the one contract. So since we just have the 100 shares, we're going to sell the NVIDIA 19th of December 195 call up there at previous highs. Let's see if we can get 345 out of this trade. Click confirm and send. Selling that one NVIDIA 19th of December 195 call with a 345 limit. There is a commission to be paid here, which would trim that credit a little bit if we're able to fill, leaving us with a minimum acceptable credit of 344.35 after commissions. And let's send that order off. And when I say minimum acceptable, I mean that about this hypothetical trader looking to sell up there at previous highs, try and get filled at or near the mid price. Now, not everybody's going to see things that way, but that order just filled. So we have a new position there at 195. And we'll follow up on that. Let's see if we can get a recovery. Now, if the stock continues to sell off, the trader might decide to reconsider being in a covered call position at all, because the shares have the ability to lose a lot more money than the call can provide as a potential income. So let's keep an eye on that. There was one other thing. Let me just quickly revisit these. So we had Broadcom, Bank of America, Google, and Microsoft. My memory is failing me. I wanted to look at one other thing. Can't remember which one it was. Comment on, there it is. Yeah, that was it. Yeah, because of this move on Alphabet, we had a plan here that if this apparent price floor, if that broke, maybe the trader is no longer as bullish. Well, now we may have a new price floor. I'm going to change this for the ongoing management of this position. Let me activate this drawing, and I'm going to nudge this up here. I'm going to say we're going to consider closing out this position if this support breaks now. That previous price ceiling may be a new price floor. And if that breaks, that might be a sign of a more significant trend reversal emerging. We'll see. But that's our new plan going forward for that trade. So guys, that's given us the opportunity to review our 5 current positions. We're talking about managing trades from sort of the back end here. Now let's talk about the entry portion of things. So let's plan and place a new income trade into this paper money portfolio. And as a backdrop for that, let's see what's going on with the stock market and with the options market. So what's happening with stocks? RB Tech Trader says, what's the reasoning for the December 19th expiration? Could it be sooner? It certainly could be. That's a really good question. How did I choose the expirations for these trades? Well, for some traders, there may be a tendency to lean toward those traditional third Friday expirations because those are the ones that tend to have the strongest liquidity. Now, that doesn't mean that the weeklies, if weeklies are available before that, there's anything inherently wrong with those. There are stocks that have very liquid weekly option contracts with narrow spreads between the bid and the ask. But for a lot of stocks out there, a lot of stocks, even if they offer weekly options, they're still not heavy trading on those weekly options. And so what that can do is it cause the bid and ask spread to widen, reflecting illiquidity scenario there and making it more difficult to get into and out of those. So what you'll see me most commonly do is just go to the third Friday. It's not the only way to do it. It will be my tendency most of the time, though, in these examples. Okay? Good question. I hope that was helpful for you. But let's see what's going on with the stock market. So here's the S&P 500. We'll use that as our sort of stand-in for what's happening with stocks in general. Obviously, it's not the only major market index that might be used for that purpose. But I think that there are plenty of technicians that might have been noting, Cameron, isn't this lower highs and lower lows in the short term since about October 29th? I think a case could be made for that. So for some, they might be wondering, has the market shifted in a significant way? Is this the beginning of a major sell-off? It could turn out to be that. But to put this into some different perspective, right now we are a net almost exactly 3% off of all-time highs. I think that could be an interesting context. It's kind of stepping back, looking at things from a broader perspective, putting things maybe into context and recognizing still really, really bullish run that we've seen. And so there could be an argument for continued bullishness. And I'm going to propose that's our hypothetical traders' continued outlook. Now, another thing that they might be looking at is this pullback has taken us, lower highs and lower lows in the short term, but that succeeded in taking us to maybe an intermediate area of support. Maybe a price floor right there. Now that I've drawn that line on there, is that a guarantee that that's going to hold as support? Nope. Things could change. We'll keep an eye on it. But let's just say that our hypothetical trader here has looked at the stock market and I still think things look bullish. So they're still going to maybe look at, if they're an income trader or investor, let's say they're looking at selling puts or selling covered calls for income. All right. Well, that's what's going on with the stock market. What about the options market? What's happening with premiums, generally speaking? Well, if we flip over here to the VIX, the VIX, premiums have recently hit highs that we haven't seen except on rare occasion over the last 6 months. When the VIX is high, that typically means that options prices are high as well, because this is a reflection of expected volatility on the S&P 500. And when traders expect a lot of volatility, that can mean that some of those traders are going to trade options to hedge positions, to hedge stock portfolios, for example. So the hedgers may demand more options. Speculators may see this volatility as carrying potential, and that can drive demand for more options. But in any case, the net here being when volatility spikes, demand for options tends to go up, and therefore pricing of options for calls and for puts tends to go up. So that's maybe what we've seen over the last 72 hours, but we've kind of been fading. So let me ask you a question. In pretty much any marketplace, if prices are high but falling, does that describe more of a buyer's market or more of a seller's market? If home prices are high but falling, be a great time to sell a house if we were thinking of selling, right? Maybe rather than waiting for prices to crash and then sell then, for example. Yeah, so some traders may describe this as a seller's market for options, which kind of aligns nicely with this webcast series because that's what we do. So, stocks, let's say our trader thinks things look bullish. For options, maybe our trader sees things as more of a seller's market. Well, let's go do a bullish selling strategy. We're going to go do a short put. So, for today's example trade, we're going to be trading Apple. Why Apple? Well, it's one of the most liquid companies in the world. Price per share can play a role for some traders when selecting options, for selecting stocks on which to trade options, but they also might look at what's going on with a chart. Now, this is me just getting kind of carried away with my drawings this morning, but it was interesting to me that these round numbers seem to be playing important roles as price floors and price ceilings for Apple traders. Now, obviously, not every trader sees things the same way, but I think it's interesting that we came down to $200 and found that as a floor, ran up to a price ceiling at 215 and popped up and through that. Where was the next floor? Interestingly, 225, which was previously a price ceiling. Next price ceiling looks like it was around 235. And we fell back down to the same floor. Well, actually, after reaching a ceiling of 240, but you get the point. On and on, that seems to have gone right up to the present day. And the most recent price floor now appears to be around 265. If you look at that 265 level, boy, over the last 4 weeks, there really hasn't been a day where Apple has closed trading below 265. So let's say that our trader here, income-oriented trader, sees this behavior of Apple and they think, looks like Apple might continue to be bullish at least to this next, and I am going to stay with that December 19th, third Friday expiration again. Now, Mighty Quinn says, is this the same as fib levels? It's unlikely to line up perfectly. I think conceptually it's the same concept. We're looking for support and resistance levels, right? But if I were to throw a fib on here, I doubt that a whole lot of these would line up. I don't know. Shall we try it? Let's do it. Let's come here to this low, and we'll go up to this most recent high. Let's just click and sort of drag up there. And I think there's some intersection of those lines. For example, the 23.6 seems to be pretty closely aligned with this previous price ceiling, that previous price ceiling back there. But like this 61.8 is sort of floating out in space, not really carrying a lot of weight. So same concept, yes. Is it exactly the same application? Not exactly. Let me remove this so I'm just uncluttering the chart. However, the trader makes I kind of hesitated to even have this part of the discussion because it's more just sort of an interesting observation. Might it have been perfectly serviceable for our bullish trader to just say, well, it looks like my most recent big resistance was broken at 260, and now support seems to be around 265, and they don't care about all the rest of this? Yeah, that might be totally fine too. Mark, that's totally legitimate too. Mark says, I think there are enough lines on the fibs to almost align with almost any group of lines. That's one of the arguments made against fibs. Yeah. Especially if we have the habit of drawing little narrow Fibonacci retracements. It just makes a whole bunch of lines, and then we can sort of retrofit whatever our bias was on the stock already to suit what we think we're seeing on the lines. Yep, that's a common argument against Fibonacci's, Mark, and no technical approach is perfect. And by the way, these webcast discussions are never a promotion or a pitch that a trader should even adopt any particular approach. It's always just educational, right? Anyway, let's just bottom line it though. Let's just say that our trader thinks, hey, there's a support there. We're bouncing off that. Let's set up an income trade that can benefit, let's just say, as long as we stay above that 265 support. So we're going to go sell a 265 put for the 19th of December. So we're going to go to the trade tab. Let's go to 19th of December. Let's go to the 265 puts. Notice we have the white background that indicates that these are the out of the money contracts. And how much can we sell that for right now? That's interesting. It looks like it's right around 1%. For some traders, they like to see 1% of the obligation they're taking on as, let's say, a minimum acceptable credit. That's not universal for every trader out there. But here's what I mean. If we were to do this, if we were to sell the 265 based on the stock just staying above 265, this would be our example trade. This is just going to be a short put for income. Sell the 19th of December, 265 put for, and let's say that we're able to get, you know what, it's trading between 268, 272. Let's just call $2.70. So here's what's happening. We're conceptually accepting a payment of $2.70 per share from someone out there in the trading universe, but in exchange, that whoever it is has the right to sell shares to us for $265. In other words, we're taking upon ourselves the obligation at someone else's whim that we might have to buy shares for $265. So that's our obligation. Well, if we have a $265 obligation and we're getting a $2.70 premium, a $2.70 incentive to get into this contract, what percentage of our obligation is that premium? Well, I know you can probably do the math on this, but I'm going to do it anyway. $2.70 on a 265 obligation is 1%. So for the next 25 days, we're being compensated to the tune of 1% to obligate ourselves to buy shares at 265. Why would we do this? Why would the trader take on such a large obligation for such a small amount of money? I put small in air quotes because actually it's a pretty good amount of money on it just for 1 month. But God, I don't like to use the word good. It's not, let's say it's not an insignificant amount of money. Anyway, here's why they might be willing to do that, because they just don't think that the other traders ever going to require them to buy the shares for 265. If the stock goes up, the other trader, even if they have the right to sell shares to us for 265, they have little motivation to do so. Those shares are worth more than 265. If they're worth 276, they'd be underpricing themselves by $11. If the stock goes up to 280, now they're underselling by 260 or by $15. So the higher the stock goes, let's just say, the more comfortable that we, as that hypothetical income trader, might feel. We're never going to have to buy the shares at 265 anyway. And just because we think we aren't going to have to buy the shares doesn't mean we won't have to buy the shares. Someone could get a wild hair, and even if the shares are worth more than 265, they could just say, you know what, Cameron, I'm selling them to you anyway. Okay, twist my arm, make me underpay for shares. Go ahead. Plus, I get to keep your $2.70. That would be a double benefit. Now, another thing is, if we do get assigned the shares, if we are required to buy the shares, is that necessarily tragic? Let's paint this picture. What if the stock comes down? Let's say it comes, I don't want fibs. Let's get rid of the fibs. That just happens to be what we're working with most recently. What if our stock falls unexpectedly before that December expiration, where we find ourselves down here at 260? Well, if someone has the right to sell shares to us for 265 that are only worth 260, they couldn't sell those shares to anybody else for 265. Are they going to go ahead and sign their contract? Yes, they're going to, with very rare exceptions. They say, Cameron, I have a contract here that says I can sell you my shares for 265, even though they're only worth 260. And I say, all right, that's terms of the contract, and the contract is assigned. And we buy those shares for 260. We're now owners of the shares, and this deal is over. Meaning, we realized the 270 income, that contract is done. So we have 270 realized income in the account, but now we own shares at 260. or that we bought for 265, they're only worth 260. That would be a built-in $5 paper loss on those shares. But what might the trader do at that point? Duke of Foxborough says it's not necessarily tragic with a quality stock. Quality can vary based on the opinion of the owner, right? But not necessarily tragic if the new shareholder considers it a quality stock, especially maybe if it pays dividends. And as shareholder now, what could we also do if we're income oriented? The trader could then maybe sell a covered call. Now, if they got assigned the shares and they think these shares are too hot to handle, maybe they're concerned the shares are just collapsing in value and they expect that to continue, well, maybe just sell the shares, pass it along, take the lumps, be done with the trade. But what we'll probably do with this one is, if assigned, we'll accept ownership, not that it's in our control. We take ownership of those shares and we'll start selling covered calls against that new share position. If we're not assigned, we'll just keep that premium and then maybe sell another put on another stock, maybe come back to Apple. That's going to be our plan, but let's go place our trade. Let's go to 19th of December, go to the 265 strike. Looks like we might be able to get a little bit better than 270 out of it right now. Let's click on the bid price and decide how many shares do we want to expose ourselves to having to purchase. How about we do 2 of these contracts? Let's do 2 of the 19th of December, 265 puts. And those are trading between 278 and 281. Let's even say that we're willing to accept 275 as our minimum. I'm just doing this to try to dial up the likelihood of a quick fill while the camera's on so everybody can see what happened. Could we maybe get more than that? Probably fairly likely, but let's click confirm and send. Let's sell 2 of the 19th of December 265 puts for a 275 minimum acceptable credit. That would give us a maximum profit of $550 from those puts. But if we have to buy the shares at 265 and the shares have collapsed to 0, if Apple goes out of business, basically, that would be our exposure to risk to the downside. There is a commission to be paid here. Let's send this order off. There we go. All right, we sold those for 277. So we're going to keep an eye on this one. Obviously, the preference here is for the stock to rally, get us to that December expiration while still above 265. We'd like to see these contracts just expire worthless, and we keep the what do we wind up collecting? $554 on those 2 contracts. JDLMI says, can you figure out what the covered call premium would be when you're selling a put today, as opposed to if we're assigned at expiration? We could, yes, I could experiment. We could estimate it is a better way for me to answer that question. There is a tool known as the theoretical pricing tool that might allow us to calculate, well, how much would calls likely be worth if the stock fell down to a certain level on expiration? We could gauge it fairly closely and sort of have a pretty good guess. I'm not going to do that, though, because it's interesting to know that, but it requires a lot of ifs. If the stock falls down to a specific level on a certain date, this will be the approximate value of those calls. But truly, to get the real value, we'd also have to have an accurate, having gotten all of that right, we'd also have to be right about where volatility levels were at that time. That's a tough ask. So I'm not going to do it. But I would say using the Theo price model on the trade tab may allow the trader to make those sorts of approximations. Okay. But guys, we're in this one. That actually rounds out. That's trade number 6. I promised you 6. You've now seen 6. Managing our trades really from start to finish. We want to understand the pros and the cons, so we try to deliver that sort of a balanced discussion. And I'm going to let you go to enjoy the other educational offerings. We have several webcasts left, a couple of webcasts left, I should say, through the rest of the trading day today. So go enjoy those. I want to thank Rachel, and it sounded like Brett. Yep. Brett helping out there in chat as well. So thanks for doing that, Rachel and Brett. But guys, I also want to make you aware of the full range of educational resources you have available to you from Schwab. First of all, make sure, if you haven't done this already, subscribe to our Trader Talks channel here on YouTube. Just go down and click on the subscribe button. It only takes a second. It doesn't cost anything. This is where we house the archives for our previous webcasts, and you can join the live streams right here. So there are live streams. You can find our previous webcasts right there under playlists. Another thing you need to be aware of is that my suggestion would be follow your favorite Schwab presenters on social media. That's the best place to connect with us in between the live streams when the cameras are off. So you can find Rachel and me on X. You can find Rachel on X at Rachel-CS. You can find me on X at Cameron May CS. And I post on here frequently. If you reply to one of my posts, I try to reply right back to you. It allows for interaction when the camera is not on. But as of a month ago, you can also follow me on LinkedIn. So my profile can be found linkedin.com/in. And then you just throw on /Cameron May CS. And that'll take you to my profile. Give me a follow, like these 126 other fabulous people. And if you reply to one of my posts here, I try to reply right back to you as well, right there. So a second way to connect with me. That's fantastic. That's really nice to be able to say that. But everybody, time for me to let you go. Thanks for helping out. And again, in the chat there, Brett and Rachel. Everyone, I will look for you in a future webcast. I'll also look for you on social media, on X and on LinkedIn. But whenever I see you again, until that moment arrives, I want to wish you the very best of luck. Happy trading. Bye-bye.